Good morning, everyone. It's great to see such a full house here. We are certainly appreciative of you all making the time to join Spear's FY25 results presentation. So welcome to you, and also to those joining online via Spear's YouTube channel. Just a quick look at what we're going to be covering during the course of the presentation. We will have some time for question and answers after the presentation, so if you do have any questions, please feel free to ask them when we are done. If you can also just state your name, your surname, and where you're from, and for those that are viewing online, if you could please email any questions you have to info@spearprop.co.za, and we'll answer them after the presentation. Joining me today are two of my execs, Christian Barnard, our CFO, and Kim Pfaff-Karg, our Chief Investment Officer. Also in the crowd is Cliff Terreen, our Chief Operations Officer, so if you can please save all the difficult questions for Cliff, we'd appreciate that. We also have quite a few of our management team and operational team here in attendance, which we want to also just welcome. Maybe just a quick recap. Today, Spear remains the only regionally focused REIT listed on the JSE. We started out life in 2011 with a 354 million rand portfolio. Fast forward a few years, JSE listing as a REIT and a few successful acquisitions and good growth. We have grown the portfolio to a 5.5 billion rand Western Cape only portfolio in the province that has the strongest property fundamentals in South Africa. Now, maybe just a bit more about the mission. As many of you have heard, our mission is to be the leading Western Cape focused REIT, to operate within the top quartile of our peer group, and also to grow our distribution annually. How do we do that? We do that through a very focused operating strategy, and that is to be value investors across the asset spectrum, to focus on asset management initiatives to grow our cash flows and to grow capital values, to also remain a consistent dividend-paying REIT. We're an income fund. Investors invest into our business for income, and our strategy is to make sure that that income is sustainable. Also to own high-quality assets, particularly in the industrial and retail space, with some really kind of identified commercial assets. But the benefit of the Western Cape is that there's become such a supply constraint that asset opportunities, we can be quite selective as to how we mix them into the portfolio. Also, importantly for us is to prudently recycle capital and also to allocate capital. We do treat capital as a scarce commodity, especially coming out of COVID, where many property companies were faced with a capital desert, where allocators just weren't allocating capital. We recognize the important role that it plays within our portfolio, and also to continuously execute on our SMART strategy. Now, our SMART strategy, some that are here today, like PSG, will remember it from our pre-listing statement, is an acronym. Now, the acronym is that we are specialized within the Western Cape. Our management is conducted internally. Our asset acquisitions are accretive. We have redevelopment opportunities within the portfolio to unlock additional bulk, creating shareholder value, and the timeous execution of our leasing strategy, and that would make up SMART. And finally, to operate with a strong balance sheet. Currently, our strategy is to operate within the 38 to 43% loan to value. Christian will delve into the detail, but we are well below that, so the business really is primed for growth, and also to operate with a very strong interest cover ratio. Maybe just having a quick look at the highlights from these results. We've grown our distributable income per share for FY25 by 3.08%. Our distribution per share has grown by 3.06%. In the rands and cents calculation, 81.27 cents per share, which is based upon a 95% payout ratio. We have seen some positive growth in the portfolio expansion for the FY25 year through a transformative acquisition of 13 assets from Emira Property Fund to a value of about 1.15 billion across 93,500 square meters. Having a look at the asset composition post the stabilization of that acquisition, 5.5 billion, 487,000 square meters, 39 high-quality assets, which have also contributed to the portfolio value growth of just on 20% for FY25. We are not a business if we can't generate strong operational performance. And if you have a look at the key drivers of what contributes towards the revenue growth that we generated for the year, you'll see that we generated a positive 4.18% growth in our reversions, which is very positive across the portfolio. We have probably one of the strongest in-force escalation rates within the sector at an average 7.27%. Our occupancy rate is very high at 97%. We do see that kind of 3% as an opportunity, given the fact that we've covered all our expenses, and that for us is profit that we're wanting to generate for the business. And as one of the early adopters of the revised SA REIT BPR, our weighted average lease expiry by GLA is 33 months. As I mentioned, the balance sheet is primed for growth at 27% LTV with an ICR of 3.34 times. We have got 600 million of liquidity availability, which we have allocated for potential transactions. So watch the space as the year progresses. We have a healthy growth pipeline. Our business will predominantly will find our growth through acquisitive acquisitions. As you saw yesterday, announced on SENS, we've acquired a multi-tenanted agri and food logistics facility in Paarl, which Kim will talk to you a little bit later. We also have a strong growth potential of just over R1 billion of opportunities, income-producing opportunities we're looking at as the start of the FY26 year, as well as a healthy development pipeline. Now, we have approximately 140,000 square meters of bulk, but we've got a development pipeline that's being unlocked of around 90,000 square meters across different parts of the portfolio, which I can give you a bit more detail of. And the rest is more kind of longer-term unlock for us. We are now 9 years into our listed journey, so liquidity is also a process and a journey. But I must say that FY25 did present really strong trade ratios for us as a business. We traded just around 63.6 million shares, which is just under 600 million rands worth of value. And we've seen a consistent improvement in liquidity despite not being included in any of the indices. And we are also hopeful that we will be included in the ORPI, the new reconstituted ORPI, which should also contribute further to improve liquidity for the business. We also, as a business, do not want to place more reliance on fossil fuel generated supply. So we've got a very clear solar strategy. We are increasing our PV solar portfolio by another 10 assets this year, which Quintin will talk to. Currently, 15 assets have got PV solar generation on property, and that generated about just over 10 megawatts of PV solar. How do we do this? Because we do use a three-pronged approach, which is a blend of installment sale systems, CapEx systems, and roof rental systems. And that kind of mix does work for us and depends on where we allocate capital and how we allocate capital. We then decide what approach we take in terms of the three-pronged approach. In terms of our tangible net asset value, despite the slight dilution of the cap raise we did in the last financial year, we did see some positive growth of over 3% in our tangible net asset value. And we also have around a 12.20 per share TNAV. Just having a look at the corporate performance, I have touched on it briefly in the prior slide, but maybe have a look at the slide on the left-hand side. When we talk to people about consistency, about predictability, and about credibility, you can also see it depicted in the total returns that we've generated to the market. Over a 5-year period, 12.5% annualized, assuming that you've reinvested your dividends. Over a 3-year annualized, around 15%. And in the last financial year, 27%. Now, coming out of COVID, you did see that kind of that 3-year annualized bump coming through. But there were a lot of tailwinds in the last financial year, which also added, capital. As I mentioned, allocators have started to reallocate capital to REITs. The US and global interest rates started to come down, as well as South African interest rates. We had the positivity of the GNU effect. And yes, we do believe it's good for democracy, despite the odd temper tantrum that gets thrown in public. But I do believe that the GNU is primed to take South Africa forward into its destiny. So all in all, from a total return perspective, we may not be the biggest, but we have provided shareholders with consistent both capital and income returns. Just having a look at the portfolio overview. Without this, we wouldn't have a business. As I've mentioned, I've already touched on the assets and on the valuation, but maybe something to point out here is that our average rental rate per square meter is 120 Rand a square meter across a diversified portfolio. We think it offers really good value. Strong in-force escalations, which we can talk about in a slight more granular detail in the slides to come. But from an asset management perspective, I think it's also important we've retained a 61% retention rate for the year. As I mentioned, we've renewed and relet 93,900 plus square meters of GLA with a positive rent reversion. The only negative reversion that we saw was in the office sector, but that has been brought into our income assumptions and our forecast assumptions for the FY26 guidance. And also excitedly, developments, in terms of the mix of where we see that kind of 90,000 square meter unlock happening, 39,000 square meters of that will happen within the industrial space, which is our George development, our Blackheath development we're planning together with contribution of the Pardon Island scheme that we are in the final stages of SDP submissions. 8,000 of retail, which is also part of our Pardon Island unlock, 3,000 of commercial, and 39,000 of residential. That excludes another 51,000 square meters of other bulk that we have available for development and unlock within the portfolio across industrial, commercial, and residential asset types. Maybe just having a look at more granular detail to really just give you a sense of what's happening on the ground. Positively, we look back in FY24 and we see the occupancy rates of FY25 printing positive across every single year. In terms of retail, just over 55,000 square meters of retail that we own. We are meaningfully looking at increasing our retail exposure. However, as many of those that are in the market know that retail assets are trading at very sharp yields. And for us, we're value investors. So we're looking for value when we purchase as much as we're looking for value one day when we sell. Our reversions, very strong at 8.5%. Collections also strong at 97.62%. What's also been a positive for us is that our larger retailers have started to allocate more and more money to capex, especially post the outcome of the GNU. Retailers are looking to increase footprint to strengthen their position in terms of market share, and we believe that we'll continue to be a net beneficiary of that. On the commercial front, probably one of the strongest comebacks that we've seen in a post-COVID era. Our commercial vacancy percentage has dropped substantially. Occupancies in FY24 were around 84%. We closed off the financial year at just under 93%. Collections were exceptionally strong at just under 100%. Reversion slightly down at about 3%. And our in-force escalations across these asset types, you can see all above 7%, which is another growth compounder from a revenue perspective for us going forward. In terms of office letting activity, it's been exceptionally strong. Cape Town has typically run out of good quality and high quality office space, especially in the Century City node, in the waterfront, and in the southern suburbs and Tiger Valley. The large occupier spaces, both within our portfolio and in other portfolios, are predominantly occupied, which bodes exceptionally well for rental growth. I think it's probably going to be, for the next 3 or so years, some of the best years within the commercial office portfolio, where typically for a long time, office rentals haven't necessarily grown as much as industrial and retail rentals. From an industrial perspective, the real cornerstone of our portfolio, the beauty of our industrial portfolio is that it typically has a broad spread of asset types from small, medium, self-storage, urban logistics, distribution, warehousing, and bulk warehousing. So we really do get the benefit of a really broad stroke of both rental opportunities, but also tenant type opportunities within our portfolio. These are multi-tenanted parks, single-tenanted operations. And again, if you have a look at what's happening in the long steel situation in the country, you look at what's happening with land costs in the Western Cape, the cost of construction makes it very difficult for developers to bring new stock onto the market at rentals that are still relatively affordable. We see our core industrial portfolio as consistently generating rental growth for the foreseeable future. In terms of the development, just an update on George. So we've now received our approvals for our urban design guidelines. The STPs are in process with council, and we're looking forward to coming out the ground there quite soon. Unfortunately, we had a couple of delays with AXA, but that's unfortunately par for the course when you're developing next to an airport. Then just a general business update. So the operating environment still remains tough. The Western Cape is not an island of independence. We are still exposed to the SA macro, but I do believe that we are on a far stronger and better footing to benefit from a real estate perspective. There's been a clear decoupling of real estate fundamentals from the rest of the country, which should also bode well for real estate in general and for Spear across our asset types. We've consistently continued to implement our PV solar strategy across the portfolio, and Christian will touch on it in his section of the presentation, but 10 of the 13 Emira assets that we acquired are in process of also getting PV solar, which will generate probably another 1.6 megawatts of supply into the Spear portfolio. Rental collections, cash is king, have been strong at just over 98%, which is also why we are comfortable in maintaining a 95% payout ratio. We don't believe that it's feasible or plausible for us to push that payout ratio beyond 95%, because property is a diminishing type of asset, and you need to consistently reinvest into capex and reinvest into your properties and the surrounding areas around your properties to continuously attract the right type of tenants. And then finally, just the portfolio enhancements. What you get when you become a shareholder in our business is that existing rental enterprise, the consistent dividend flow, but also you get this embedded bulk at a zero cost. And we're constantly looking at how we can continuously unlock these opportunities for shareholders as we go, but do it in a responsible manner, given the fact that developments are not for sissies. We have some of the best developers in South Africa in the room, and they can attest to that it's no bed of roses. And just having a look at the portfolio composition from a value, revenue, and GLA perspective, I'm not going to get into too much detail, but just to point out that in the last results presentation, I pointed out that we put a lot of work into getting an equilibrium in terms of value and revenue between commercial and industrial. Given the fact that our industrial performance consistently was stronger than obviously commercial for obvious reasons because of COVID and so on and so forth. And we've done a very good job of that. You can see that we are almost at a 50-50 split, and this does not take into account yet yesterday's announcement of the Pole acquisition, which will probably see commercial at 2.3 billion plus and industrial also at 2.3 billion plus post that acquisition being implemented. Revenue around 682 million rand for the year across the assets. 42% of our revenue was generated by the commercial portfolio, 38% by industrial, 16% by retail, and about 4% was generated through renewable energy, which also Christian will talk about later on in the presentation. Occupancy rates are high across the board, 93% from an office portfolio perspective, 99% on industrial, and 96% on retail. And then just to kind of granularize it slightly more for you, as I mentioned, we invest into logistics, urban logistics, manufacturing, mini units, and large bulk storage. And you can see that from a subsectoral diversification perspective, we haven't just diversified across the key industrial nodes within Cape Town. We've diversified across different asset types, which we believe kind of is also a key ingredient to a very defensive portfolio. Pre the implementation of the Pole acquisition, our GLA is around 304,000 square meters and a very healthy occupancy rate, and that contributed just under 280 million rand of revenue for the year. In terms of commercial, as mentioned, 2.3 billion of commercial assets contributing just under 288 million rand for the year across 127,000 square meters of GLA with an occupancy rate of just under 99%. And again, from an investment perspective, we're investing into high quality nodes within the Western Cape, nodes that are supported by retail, that are supported by public transport infrastructure, that are supported by other attractions that are not islands of independence, because a property standing on its own may not have the strength of rental growth that you would see in a mixed-use development like Century City, as an example. And then in terms of retail, there is a clear strategy to grow this part of the portfolio. But as I mentioned, retail is expensive, and we are value investors. But within that kind of billion rand growth pipeline that I sketched out earlier, there are some retail opportunities within that pipeline, and we are working very hard to see how we can unlock those opportunities into the Spear portfolio. The contribution from retail was around 114 million for the year across the 55,000 square meters of GLA with a strong occupancy rate of around 96%. So moving on to the letting activity, this is also where our leasing team and our asset manager and our chief operations officer spend a lot of their time and focus, is retaining tenants and replacing tenants that have vacated. So for the year, we had 94,800 come up for renewal and relet. That was an expiry rental of about 10.2 million at around 107 rand a square meter. We renewed and relet 93,959 square meters at an opening rental of 10.5 million and an average rental of about 112 rand per square meter, which gives us that positive rent reversion print. Over and above that, post year end, we also had strong letting activity into the industrial and office part of the portfolio. As you can see below, additional 7,500 was let from the 1st of March, and then a 1,500 and 237 let 1 March and 1 April. Just a composition of our tenant mix. So 47% of our tenants are large national listed and international businesses, 45% are national tenants, smaller listed tenants, and then 5%, which are about 124 tenants, entrepreneurial businesses, type of owner-run businesses, etc. But by far, you can see the bulk of our tenant profile, which also is a credit risk mitigator, are within the top kind of quartile of tenancies. In terms of lease expiry, we've got between 18 and 19% of our portfolio comes up for renewal and relet every year across the core portfolio. We have consistently achieved ahead of, so we have about a 6 to 8 month early engagement strategy when it comes to lease renewals. Leases that we see as high risk will obviously be dealt with in a different manner. It might be slightly longer than 6 to 8 months, but we see this as a very benign lease expiry profile where you can see on average about 19%. And we do see in 2026, 2027, obviously there's a bit of a spike in retail, which is one of our large retail tenants at Sable Square that'll come up, and we've already engaged them to further extend their lease with us. That's it from me for now. I'm going to hand over to Christian Barnard to take us through the financial performance. Christian.
Morning, everyone. So I'll take you through a bit more of the detail of the financials. It's always the boring part, so bear with me. It's why I can always talk so quick to get it over for you guys. Looking at our income statement for the year, our revenue, top line revenue grew by 12.1%. But I think for me, more important is the like-for-like growth of 11.19%. That is testament to the work our team does. That is the growth in the rental reversions, which is positive, filling vacancies, is continuously, because remember, every vacant space you fill drops to the bottom line. You've already covered your op costs. So it's important to fill those spaces that immediately drops to your bottom line. So that is a key factor for us to understand that our core portfolio performs very, very well. And then in terms of our net property operating profit, that grew by 10.45% for the year. Like-for-like basis grew by 6.42% for the year. Then in terms of our interest we paid for the year declined by 24.52% for the year. Now, that is due to a very strong support from our shareholders in a capital raise we did in August and September, declining interest rates, renegotiating debt at lower margins, and settling 400 million of debt from disposals, all accumulating in a lower interest bill for the year, again increasing our distributions for the year. Now, that resulted in an ICR of 3.34 times, well ahead of our covenant of 2 times, and significantly improving in the prior financial year. Now, we do forecast that this will remain in this level between the 3 to the 3.2 mark for the next financial year, as we still operate in a very, very low LTV, and our margins in our debt has improved. Now, just taking a step back to our operating costs for the year, our SA REIT total cost of income was 44.37%, and the admin cost was at 6.78%. Now, this is slightly elevated from the prior financial year, but that has a reason. We had some pre-implementation costs for the Emira acquisition. A lot of the staff that we had to employ was to have to be well before the acquisition took place to ensure a smooth transition of the assets to the Sphere portfolio. Those costs will smooth line out through the next financial year, bring it back into the line where we normally operate between 42 to 43% for total cost and 6 to 6.5% for admin cost. So we are not concerned about these numbers. They are already, we know what's happening in our budgets. The numbers are smooth lining out, and it's been absorbed into the portfolio as it was budgeted for. Then a lot of these numbers Quintin has mentioned, but if it's good, it's worth repeating. Our distributions for the year that we generated was 8.55 cents per share, distributable income per share, which grew at 3.08 cents per share. Some of those who were here in October would have recalled we did have a slight delay in the transaction under Fairways, where the property we subsequently disposed of a transaction, about 4 months, which did result in about a 1.5% decrease in our total distributable income. But yet, the property was disposed and debt was accretive for exit. So we could have performed well better, but we absorbed all those costs and we still managed to grow throughout the financial year to this point in time. Again, I'm very proud to present this FFO recon to our shareholders. It is simplistic. There's nothing hidden here. It's see-through, it's clear. There's no funny reversals that is not IFRS related. That is how we run our business. We make sure we are simplistic and easy to understand because we want you guys to know what you invest in. A pure property operator. That is important for us. The one element in here which is antecedent dividend earnings, which results relating to the capital raise we did in August and September, which is added back to smooth line the income for the year as part of the capital that you do raise and pay out to your shareholders. Then just looking at the distribution per share, as Quintin mentioned, we applied a 95% payout ratio, which is similar to the prior financial year, giving us a total dividend for the year of 81.27 cents per share, which is a 3.06 growth for the financial year. That's after applying and using total net shares of 320 million shares. We have 339 million rand of gross shares. We do have some shares in treasury, which we will utilize for our future use if the time is right, and we'll issue it into the market if we find a reason to do so, or we will keep them back to use for our staff incentive schemes, as we've always done to buy creatively in the market rather than issuing new shares. Then again, our balance sheet, again, we work really, really hard to keep this simplistic. We want to make sure we have capacity to grow. We make sure we pay debt down when we can. We refinance debt when we can. And we obviously, as you can see, 5.5 billion rand of assets, a net asset value of 3.9 billion, total liabilities of 1.7 billion, resulting in a TNAV of 12.20 rand for the year and an LTV of 27.09%, which actually is far below, almost 4% below the number we forecasted in our Category 1 circular for the Emira transaction. Just showcasing the work we've done to get to this point. So the support from our shareholders, obviously, in giving a good capital raise, getting debts at the better rates than we anticipated, resulted in good earnings, lower LTVs, everything giving positive fruits for the shareholders. Now let's just look a bit more detail on the TNAV and the LTV sensitivity. So we started the year on a TNAV of 11.78, which grew by 3.57% to 12.20. Now, the two items that stands out in the top bar is the capital raise decline and the increase in the fair value in the shares. When we did this capital raise, I distinctly remember a lot of the questions was, why do you raise this capital below your NAV? Please explain how you're going to get back to your NAV. Why the delusion? And we made sure to explain to our shareholders, our asset management strategy is in place. We know what we're buying, we know what we're operating, we know the work we're putting in place. And as you can see by the increase in fair value adjustments, the decrease in the capital raise is far less than what the increase was on fair value adjustment, giving the strong performance of our portfolio. Hence, even after the decline in the capital raise, it still grew for the financial year. Just further showcasing that shareholders can trust us with their money. There's always a plan in place to make sure their value grow within Sphere. LTV sensitivity, starting the period of 27.09%. But in the next 12 to 24 months, we have a substantial amount of projects on the go, which Kim will touch on, Quintin has touched on a few, but a little bit more granular detail. One of our largest industrial parks is Blackheath Park, which we are currently undergoing a 52 million rand entire full roof asbestos replacement. This is to allow us to actually install solar PV, because you cannot install solar on asbestos currently per regulations. The total project is 52 million. At year end, we have spent 20 million, and the project is still undergo. It will undergo for the rest of the year. It is quite a tedious project to actually remove asbestos and then install the solar. Then post that, in June, we will pay our final dividend. Then GAT phase 1 and 2, as Quintin mentioned, there was a slight delay of AXA. Now the only work left after the civils is the boundary walls and perimeter construction needs to happen, and that's the final cost that we will spend there before we go to top structure. Barn Island development, which Kim will touch on, we've allocated some cash reserves towards the professional fees to get us to the development stage, which we'll use our cash reserves that we generated through the year. Blackheath phase 2, again, Kim will touch on that. We have a bit of land and we've allocated cash to build. So we don't have to buy the land, we already own it. It's currently standing next to our park, and we've allocated cash towards that to build for the year. Then GAT portion 8 is the first portion of the top structure we wish to build. I'm very happy our chair for investment committee is here, because we still have to ask him if we can build on spec or not. We don't know. We have to do some begging and pleading, but we are planning, and we're showing him we're planning for it. So, but then we have an asset that we are holding for disposal. Post all of this, we are still forecasting that our LTV be 30.48%, well below our target operating range, give us a substantial amount of leverage to actually buy in the market using debt as if we need to use debt. But as you saw of yesterday's transaction, our shares are in demand for Section 42s, and we are managed to do both debt and share issuance to buy assets in the market. Then in terms of our total debt for the period, our total net debt is 1.5 billion, of which 77% is fixed. Our strategy, as set from the board, is to have a fixed ratio between 65 and 75%. So we are slightly above that. But as you operate, you collect cash, you actually pay out dividends, that moves within that band. So we are not concerned with being over-hedged. It will move within the band, slightly below, slightly over in periods of time. Of the 77% fixed debt, our all-in cost is 9.01%, with an average maturity of 20 months. The 23% variable debt has an all-in cost of 9.29%, which has an average maturity of 26 months. Now, as most of you know, any debt you take from the bank, the underlying debt is variable. Then you overlay fixed and swaps over that debt to get to your fixed percentage. So the pie chart in the middle gives you the maturity of the underlying variable debt. The pie chart on the far right is your fixes that's being overlaid on top of that to give you the 77% of fixes that sits in the portfolio. Now, you will note that there is a 29% coming up for renewal in the underlying variable debt in FY26. I'm happy to report that has been extended for 3 years post year end. So we couldn't include in year end because the agreement wasn't signed. That has been done. So that has been mitigated, as well as a 2-year swap being overlaid again from August. So the majority of our renewals for the FY26 year has been done, with the subsequent one only happening in February 2026, quite far down the line, which we'll start negotiating August, September to make sure that we renew that number. We did refinance 484 million rand of debt, lowering our average margin from 1.7 to 1.55 in the group, which I think is substantial, as you can see with the overall debt that we've paid in the group. We settled 401 million rand of debt. That's post disposal of the Liberty Life building and the 142 Ed building in Tiger Valley. And we still have 600 million rand of undrawn facilities, which we will allocate 200 million for the LTV vicinity projects and all the projects we have in the portfolio we will utilize. Then just a reminder to all our shareholders of our covenants, LTV of 50% and an ICR of 2 times. We are by no means close to breaching any of these covenants. We are well above them, and we do forecast to remain at these levels for quite a foreseeable future. And just a further reminder of the actual all-in cost of debt at year end and at the prior financial year to see what actually has happened. Now, it's just a reminder to everyone, some of these costs you will see, but hold on. Interest rates has dropped by 75 bips. Why have your debt not come down? You must remember, when they announce actual cost of debt, when they announce a cut, some of our debt are rolling 3 months, it moves in periods. It's only if you're a prime rate unfixed, you get an immediate reprieve. Most of listed funds works on 3 months JIBAR, so it gets reset at 3 months intervals. So you don't get an immediate benefit at some points. So sometimes you just catch it very lucky, it's immediate. Sometimes you have to wait a couple of months before it actually is implemented. So this is just a brief overview of all the financial stats that we have discussed today, which is a good, easy printout to send to all your clients and fund managers to make sure they invest in Spear going forward. Then I think the one element that in here which I'm very, very proud of is in this financial year, if you look at the second column on cash collections, 74 million free cash flow generated from operations. That's after paying dividends, after doing all our capital projects, all operating expenditure has been covered. That is what we generate as free cash flow within our group. That is a very important metric because that's money we can utilize to enhance our portfolio, do future projects, build new anything we don't need to go to the bank and ask for more money. That is a very important metric, and I think it's something that's overlooked in the REIT industry if it's a pure property operating cash generation business. And I think that is important for us. Hence, I have some free cash flow, which goes into the solar PV strategy. We have 15 assets with solar installed, which generated 10 megawatt of power as Quintin generated. We recently employed a new utility manager who is overseeing this for us and helping us generate even more free cash flow from our business in terms of our solar PV. But given that we have some free cash flow that's sitting in cash accounts in banks, we need to do something with either improve your facility, build on, do repairs and maintenance capex projects. But we've seen solar PV systems, internal rate of return is between 16 and 21%. So why not use your money to install more solar on your business and generate cash flow for your business? So we are currently in the implementation phase of 10 further systems, ranging from industrial assets, retail assets to commercial assets. All of them have different, depending on the use, the tariffs, the structures, the IRRs differ. Everyone has a different element of profitability for the group. But in the past financial year, and this is the reason why we're doing it, we saw solar has grown to being 4% of our actual revenue for the group, being 28 million rand. Where our expense, meaning if we do finance it, was only 12 million for the year on that. So meaning we actually generated NOI for the group of 16 million from solar alone. That is revenue from non-GLA properties. That's why we do it. So if I have 74 million, it's going to cost me 20 million to do some more, to generate another 1.6 million. That is a good return. So we keep investing into those assets, as well as it does give us optionality in future if time arises that we do not have to escalate our electricity rates, the same tariffs that NERSA and the City of Cape Town does, if we so decide, after systems has been paid back. Currently, given the tariff escalations that's been proposed, all of these systems will have a maximum 3-year payback period if we do even spend our capex to see where our returns are. So it's an exceptional investment to make in your properties. Then for me, it's very interesting to see that our top 3 power producing assets in our portfolio actually use 55% of our power. One of them being Mega Park, which is an 85,000 square meter industrial facility, which has about 50% manufacturing. Now that asset has one of the highest incoming power facilities in the Cape Town. Also, it's in a curtailment area, so it doesn't get load shedding up until level 4, meaning power manufacturers want to be there. We have a waiting list of people to be in there, but no one is leaving that is manufacturing because they have certainty of their business operations. So we're continuously replacing asbestos, upgrading roofs and installing solar, and this asset alone has over 3 megawatts of solar capacity already on its roofs, and it has capacity to be more. So this will continue to be a new segment within the Spear portfolio, and we will grow it, and it will only become more profitable as it runs because these systems are now becoming out of their payback periods within fully cash generating operations for Spear. So that's all from me, and Kim will now tell you about all the nice things she's going to buy for you.
Thank you very much, Christian. Good morning, everybody. Thank you for joining us today. I'm going to be covering our current position and our progress across our acquisitions and disposals, our active and up-and-coming developments, and finally ending off with our year-end valuations. But before diving in, I want to briefly recap the core of Spear's investment strategy. Essentially, we have 6 key principles that continue to guide and shape our portfolio. Firstly, we only invest in the Western Cape. It is a region that we know, we believe in, and one that continues to deliver value. This focus remains central to our growth strategy. While we are diversified across industrial, retail, and office assets, we maintain a strong bias towards industrial and retail assets, both in terms of our gross lettable area and our overall portfolio value. We typically target assets that are 100 million rand and above. However, we do remain open to strategic opportunities where there is immediate upside, development potential, or strong long-term value. We are selective. Growth for us means acquiring the right assets that align with our criteria, and it's not just about adding to the numbers. Within our portfolio, we have approximately 140,000 square meters of available bulk across our portfolio, which represents a valuable future development pipeline, which we will unlock as and when the market timing is right. And lastly, with a portfolio that is currently at 5.5 billion rand, our long-term vision is clear: to grow Spear to a focused mid-cap fund in the region of 15 billion rand, which we believe is the optimal size for our Western Cape only fund. Moving on to our acquisitions and disposals. We've made strong progress on the acquisitions front this year, having successfully stabilized the 1.15 billion rand Emura property transaction. Now, this was a major step forward in scaling our fund, and I'm pleased to report that both income and expenditure performance on the assets or on the portfolio is in line with our forecasts. This 13 property portfolio, comprising around 93,500 square meters of GLA, has integrated seamlessly into our core base and aligns well with Spear's long-term investment strategy. Since taking full internal management of the portfolio, as it was previously externally managed, we have already started implementing value-adding upgrades such as PV solar, roof replacements, and redecorations. In addition, we do expect to achieve further cost efficiencies that will boost the portfolio's performance. On the disposal side, we have concluded the sale of 3 office assets in line with our strategic recycling of capital. None of these transactions are new, they just happen to have transferred in the last 12 months. So to recap, firstly, we have the Liberty Life building, which we sold for 400 million rand to Capitec Bank, who will occupy the building themselves. 142 Edward Street in Tiger Valley. This was a non-core asset that we sold for 43 million rand to a private investor. And 100 Fairways Close in Parow, also known as the M-Web building, that we sold for 160 million rand to the City of Cape Town, another strong owner-occupier transaction. As mentioned previously, we are very excited to announce that yesterday we concluded the sale or the acquisition of Berg River Business Park in Paarl for 182 million rand, more or less, which works out to just around 6,000 rand a square meter. Now, Berg River Business Park is a 30,000 square meter, high quality, multi-tenanted, light industrial business park, primarily servicing tenants in the food and wine industries. This acquisition entrenches Spear's presence in strategic key nodes in the Western Cape and not just the Cape Town metropole. Paarl has experienced strong growth in recent years, and we are confident in the long-term rental prospects of this region. What makes this transaction particularly noteworthy is that the sellers have opted to vend in the asset for Spear shares. This not only reflects their confidence in our business, but also highlights the compelling value proposition that we offer, not just to our shareholders, but also to counterparties seeking to convert direct real estate ownership into indirect exposure to the Western Cape real estate. A couple of statistics about the park. The average rental passing is 57 Rand per square meter gross, which is good value. The purchase yield attributable to shareholders as at the date of transfer, which we expect to be in September, more or less, is at 9.35%. The weighted average escalation of the tenants in the portfolio is just over 7%, and the weighted average duration of the lease term just over 5 years. And the park is fully let. This acquisition is still subject to Competition Commission approval, and all things being equal, as I mentioned, we believe we'll take transfer in September this year. Now moving on to our developments. Firstly, we have GTX Park in George in the Garden Route. Excellent progress has been made at GTX Park, which is our greenfield development opportunity that is located directly opposite the George Airport. The site phase 1 civils, electrical infrastructure, landscaping and internal roads are all complete. As Quintin mentioned earlier, the site development plan for the perimeter wall and entrance has been submitted to the George municipality. Once that has been approved and the works have been complete, we will then be in a position to commence with our first top structure. As a reminder, this park allows for up to 30,000 square meters of light industrial warehousing, which will be developed in phases to tenant specifications. Unit sizes will typically vary between 300 square meters up to a 10,000 square meter box if so required. As you can see from the slides above, the park is already well landscaped and visually taking shape. The total development cost of GTX Park will be 300 million Rand, or estimated to be around there, and this will take place over a 3 to 5 year horizon. GTX Park remains a strategic investment for Spear, offering long-term value creation in the growing Garden Route region. Bravo Park, Blackheath, this is the extension. This is an attractive opportunity within one of our existing assets known as Bravo Park, where there's a vacant piece of land where we can develop a 7,000 square meter warehouse. The land use management process is underway and our plans are currently with council for approval. Construction will commence as soon as we have secured a suitable user, and the development cost is estimated to be around 66.5 million Rand. Now, this is a prime opportunity to grow our portfolio organically, utilizing a portion of that 140,000 square meters of available bulk. The Anchorage Pardon Island. Now, this development was previously known for many years as Marine Place. But due to the recent construction just down the road of Rossi developers, where they have, you may have seen it as you're driving past in Pardon Island, they have named their development Maritime Place. So in order to avoid any confusion, we have renamed our development the Anchorage. The Anchorage represents one of Spear's most exciting long-term mixed-use development opportunities, comprising 3 of our adjoining assets, known as 28 to 34 Marine Drive in Pardon Island. Given the scale of this development, it is both feasibility and demand-driven. We are currently in the process of refining the feasibility model and progressing through the design process in consultation with the City of Cape Town. The site benefits from a total approved rights of around 52,000 square meters. Our planned high-level development vision includes an 8,000 square meter convenience retail centre at ground floor, a component of offices and light modern industrial units being around 2,000 square meters each, and a part hotel, which, please note, will be structured as a trading opportunity and to a third-party operator. We will not be getting back into hospitality. And 2 residential towers that will be developed in 2 phases, comprising around 440 apartments in the first phase, being primarily studios, 1-beds and 2-bedroom apartments. All sectional title residential units will be earmarked as trading stock, and we will not be retaining these units as rental stock. Our strategy is to use the proceeds from the residential sales to offset the costs of the non-residential components, which will be retained by Spear. A comprehensive market study has confirmed strong support for this site of a retail offering of up to 11,000 square meters, as well as residential demand of around 1,000 units by 2027, growing to about 1,500 units by 2029 within our targeted range. The success of Maritime Place, which is already 85% sold out, reinforces both the attractiveness of our product, but also the ongoing shift in Pardon Island from a purely industrial node to a vibrant mixed-use precinct. The estimated total cost of this development will be around 1.6 billion rand. And finally, moving on to property valuations. At year end, the total value of Spear's income-generating portfolio, that is excluding land, increased to 5.43 billion rand, reflecting a 5.03% increase compared to August 2024. Now, this equates to a meaningful value accretion of approximately 261 million rand over the 6-month period. Approximately 70% of our portfolio was valued externally, and the remainder of the assets are valued by myself. For those of you who do not know, I am a registered qualified professional valuer. Further, all of the valuations are reviewed by me and overseen or approved by our experienced executive committee. A few key highlights from the valuation model. The total number of properties has increased from 29 to 39 assets. Now, this is following the successful integration of the Emira portfolio, less the disposal of our 3 office assets. The total gross lettable area of our portfolio is 487,000 square meters, with a strong weighting across industrial being 304,000 square meters, offices at 127,000 square meters, and retail at 56,000 square meters. I'm pleased to report that we've seen positive growth across all sectors, both in terms of capital value and yield performance. Our average industrial property is valued at around 7,000 rand a square meter. Our average office property at around 18,000 a square meter, and the vast majority of our offices are A-grade. And retail, the average valuation is 17,500 rand a square meter. Now, for those of you that understand and know rates per square meter per sector, will know and understand that our portfolio is conservatively valued, especially given that the good quality of the assets and all being located in the Western Cape. The positive performance that we have seen in our portfolio has primarily been driven by improved occupancy levels, significant increases in market rentals in all sectors, but particularly and surprisingly in the office sector, and of course strengthening of capitalization rates, where we've seen numerous transactions occurring in the Western Cape. And these are trends that are consistent with a broader positive momentum that has been reported across the Cape Town property market. And finally, as always, I mentioned we do not value any bulk in our portfolio, of which we have 140,000 square meters, and this represents significant upside as and when we choose to unlock this bulk in a measured strategic manner. Thank you very much. I'll now hand back over to Quintin who will close the presentation.
Thank you, Christian, and thank you, Kim. Excellent presentation. Looking forward, I think our opportunities are very exciting, and we will make sure that we deliver on the mission in the year ahead. But just having a look forward, I mean, the Western Cape for us is not just a region. It really is Africa's frontier of innovation, stability, and opportunity. We have a globally competitive economy within the province. We have world-class infrastructure, even though we are boxing a little bit with the City of Cape Town as to how much they want to charge for that infrastructure. They are doing an excellent job. And also it offers investors an ideal mix of growth potential and risk mitigation in South Africa and in the continent. And for us, this is incredibly important because you can't just trade out of bricks and mortar like you can trade out of an equity. So being invested in the right region, with the right municipality, with the right infrastructure, effectively is a key ingredient to the ongoing success of Spear and obviously of the Western Cape. Real estate fundamentals will continue to strengthen within the Western Cape. I think we can, without a shadow of a doubt, agree that the Western Cape, certainly across the province, is a very strong investment opportunity, not just for Spear, but for many developers and investors. And as you see the trends of semi-migration continue to flow into the province, it'll just continue to strengthen real estate fundamentals and also drive up property values. Our Western Cape portfolio, kind of zooming into the portfolio, remains exceptionally strong, a very resilient portfolio that is supported by high tenant retention rates, also very strong lease covenants, which for us is key to a sustainable cash flow, rent preservation, and tenant preservation strategy. We also remain very close to our assets. In Afrikaans there's a saying, ver van jou goed, naby aan jou skade, which means that if you're too far away from your assets, the damage might be closer than what you think. And for us, we are within 1 hour of every single one of our properties. We have an acute understanding of the market, and we are able to move quickly and swiftly as market conditions may change, which sometimes can happen quite quickly, as we saw even coming out of COVID. As Kim mentioned, we retain a very strong pipeline of both greenfields and brownfields development opportunities, which again will be unlocked in a patient manner, also in a manner that in the event of us trading some of that bulk without taking the development risk but unlocking the value for shareholders, we would certainly also look at those types of opportunities. And we're also confident, when we sat and prepared the guidance outlook and the guidance for FY26, we looked back at the key performance indicators from FY25, and we looked forward in terms of where things were going from a tenant profile perspective. And we are confident that from a strategy perspective, from an asset management and a property management perspective, that we are well positioned to successfully execute on our mission for FY26. And also, I think one cannot also underscore the importance that the Western Cape government is playing in the success of Spear. A lowering unemployment rate, which is the lowest unemployment rate in the country, puts more money in people's pockets, which allows them to shop at our retail centres. It allows them to buy furniture from our industrial tenants or buy water bottles or whatever they manufacture from our tenants, which allows our tenants to generate revenue and allows them to pay our rent, which ultimately is we're a glorified leasing operation. So if everybody can pay their rent, we're all in business and we're all happy. And then finally, we are committed to being a responsible investor. We are committed to playing our part to look after the environment. We're committed to holding local government, local authority to account for things like the budget. We don't just consider our assets as our little patch. We see the whole Western Cape as an investment opportunity. And also, we see ourselves as stewards of your capital and of your investment. You can invest anywhere, actually, if you want to, because the world it's open to you, but you've chosen to invest into us. So we do believe that the outlook for our business is exceptionally strong for the year ahead. Just in terms of some key strategic priorities for us in the year ahead, for us, portfolio growth and optimization it's not there's no incentive for us to just grow for the sake of growing. The incentive for us is to maintain consistent income, which is critical, high occupancy rates, but also to continue to acquire yield-enhancing asset opportunities within the Western Cape. Also to prudently manage our capital, as Christian nicely put, we can sit and, we have a 100 million rand kind of acquisition strategy minimum. However, if we can spend 20 million on solar, we're not going to necessarily go buy a 20 million rand property, but there's a strong business case to increase asset performance by investing 20 million rand into PV solar. When our shares were trading at a deep discount to their net asset value, the most accretive thing that we could do was repurchase our own shares, which again, just shows that we have a respect for how we allocate capital within the business. In terms of shareholder alignment, we still own north of 20% of this business, so we all have a lot of skin in the game. Also, this year saw the introduction of a executive minimum shareholding requirement within our remuneration structure of the business. So every executive will, by 2029, have to have a certain percentage shareholding within the business, which again just aligns management interests and shareholders' interests, because we don't just think as a management team, we think as owners, and owners think long-term and multi-generational. In terms of sustainable growth, we do plan to actively manage our debt portfolio, to also manage our human capital. Without our people, we don't have a business, so we want to provide an environment that's conducive to attract the best in class, to contribute towards our business, and also to consistently execute against our ESG strategy. We believe that generosity is also a privilege, and the more generous you are within certain aspects of your life, your universe does expand. And that's also a key part of our ESG strategy. And also to remain tenant-centric. Our approach is to understand that our tenants are both shareholders in our business and we equally shareholders in their business. And our strong tenant relations are to be maintained, which will also be supportive of the high occupancy rates that we are reflecting in this presentation. Then just having a look to the year ahead, we do remain, as I said, committed to the Western Cape only focused strategy, which is a hands-on strategy which will allow us to access more portfolio opportunities going forward. And just based upon the information that we have at our disposal at today's presentation, we are guiding that FY26 distributable income per share will be about 4 to 6% higher than FY25. We do expect to maintain the payout ratio at 95%. As Christian pointed out, the strong free cash flow generation of the business doesn't require us to push it any higher. And also LTV is well below the band. Like most things in life, there are a few conditions or terms and conditions attributable to this forecast. We have seen some limited elements of load shedding coming through in South Africa, but north of 92% of our electricity supply within our portfolio is supplied by the City of Cape Town. The City of Cape Town operates at 2 levels below the national average, which means that for all intents and purposes, we actually haven't had load shedding, and we don't anticipate load shedding for the foreseeable future, especially now that the City of Cape Town has already commenced the first phase of their power tenders, plus in 2026 we'll see the dispatchable power program coming through, which should, by all intents and purposes, according to the city, eliminate load shedding from stage 1 to stage 4 for city customers. Its qualification is that we reduce our vacancies in line with our strategy. We've got no tenant failures, and also tenants are able to absorb the increasing costs. And many of us in the room here have been lobbying the city in terms of increases, and we do believe that there will be some fruits from that engagement that will hopefully come through an amended budget process. And then we've said that the SARB repo rate reduction of around 0.25% is implemented in this year, which has formed one of the bases of our assumptions, and no civil unrest across South Africa, which will help us all to sleep better at night. But obviously any deviation from these assumptions may have an impact on our guidance, But as always, we are highly accessible as a management team, and we will communicate through either a quarterly update or market communication if anything requires updating from that. That brings us to the end of the presentation. Thank you very much all for attending, both online and in person. We're going to take some time now for a Q&A. So if you could again just state your name and where you're from and your question, then that'll be appreciated. So maybe if we can just start, is there a microphone? There is a microphone, so if anybody has a question, we can quickly get into those questions.
Thank you. The name's Abe Gordon.
Hi, Abe.
I'm associated with Signal Asset Management also. I'm going to put my questions together while I talk. I've got to work it out. But being a focused Western Province operator, holding land is very, very important because of the growing scarcity. So when we talk about 12 Rand asset value, and if we're not so conservative in valuing the bulk, what could we add to asset value? Perhaps that's a question for Kim. I mean, could we add 1 or 2 Rand to that just as an estimate above the 12 Rand because of the bulk that you've got of 120, 140,000 square meters? That's my first question. The second one, and particularly that you have ambitions one day to get to the 15 billion Rand capitalisation. I think holding land is very important, and unfortunately it doesn't offer yields in the near future. But if you take, for example, Cape Town Airport that they're developing beyond Durbanville, surely it pays to hold quite a portion of land, or farmland even, where shareholders would have to appreciate that there's a long-term potential. I just get the impression of the 74 million of cash flow that you're getting, a lot of it's going to go into present operations and not the long-term opportunity that I perceive. Thank you.
Cool, thanks, Abe. So just on a conservative basis, given the kind of mixed nature of the bulk that we have available, it's probably 400 million Rand, roughly, in terms of that we don't value anywhere on the balance sheet. Roughly 400 million, correct. So I think one of the benefits of having a lot of skin in the game is that you are very meticulous as to how you allocate capital, especially as an income fund. And I think, we've also learned from certain of the other property funds what to do and what not to do. And it becomes increasingly more difficult for a public balance sheet or an income fund like Spear to sit on massive land holdings because it's dilutive. And over and above that, you've got your construction, you've got a lot of fluctuations from your land cost, your servicing costs, your construction costs, etc., where your return would have to be well in excess of call it normalized investment type of property return. We have over R1 billion worth of income producing opportunities we're looking at. And I can guarantee you that we've got no shortage of opportunities over and above R1 billion for us to achieve whatever that kind of strategic kind of long-term goal is to get to a 15 billion Rand portfolio value. And quite frankly, if we don't get to 15 billion, but our business has remained resilient, it's been able to abide by its mission of being a authentic dividend-paying REIT, and maybe we just get to 10 billion, it's not going to be a big issue because we're not going to fail the class test. When we start to deviate from, starting to get into a bit of development here and taking long land positions, you also run into issues where your auditors start putting pressure on you because you need to now start expensing things out of your income statement, and there's no income to support it. So development it's a very risky business. And as I said, we're stewarding this business as managers and as owners. And if I had to choose between a high quality income producing asset giving me a 9.1 or 9.4% return versus a land holding that may be still agricultural, remember the agricultural still has to be rezoned. So that's a 5-year kind of process, assuming that there's no other issues that come political or environmental that come with that. So I think the lion's share of our business will be focused on growing the investment property component of our business. Unlocking the bulk as and when the opportunity presents itself is definitely part of our strategy. But we've also in the past been able to rezone assets, add value to those assets, and actually on-sell those assets at a significant premium without taking the development risk, which has had the same effect on the NAV uplift for shareholders. So we're very strategic as to how and when we assess those types of opportunities. And that just talks to obviously the land holding impact as to there is obviously, if you want to have first mover advantage, acquire the land, service it, top structure, etc., and be ready to go. But there's always a cost. There's always a cost to that, and unfortunately, we, from a strategy perspective, have a plan, and we feel that plan is supported by our board, and also very supportive from our shareholders, as we saw from the Emira transaction.
Thank you.
Yeah. Any other questions online, Christian?
The first is from Trinity. I think it's from Anke, yes. So, Quintin, P-grade office properties in the Western Cape are virtually fully let. A-grade vacancies are below 3.5%, and B-grade vacancies remain relatively high at 12%. According to SAPOA Q1 24 office update, do you think it's worth refurbishing, converting some of these P-grade offices into A and P grade to capture the elevated demand in the A and P grade office space, which is exacerbated at the moment?
So we've got about 8,000 square meters of office vacancy in the portfolio, and probably about 2,000 square meters has been earmarked for a refurbishment. The balance is just that kind of portfolio churn, and the properties that have got those vacancies are of high quality. So first of all, the cost, we don't have, as I mentioned, 8,000 isn't really a lot of vacant offices in the total bigger scheme of things. So we're very happy that our offices actually are all of a good enough quality to attract tenants without the need to implement some sort of a redevelopment, which obviously will come with a vacancy, a capex, etc., etc. So yeah, hopefully that answers the question.
Just two more. I think I'll take these. Again from Trinity, could you kindly provide absolute figures on how much cash will be funded the Bergrivier property and how many shares will be issued and what will the effect on the NAV per share? So currently it's a little bit of a fluid transaction. The seller is busy with some works on the property, which is for his account, and his facility we estimate will end up at about 45 million, which we will settle in cash, and the balance being in shares, which should equate to about 14 to 14.2 million shares, all depending on how much cash actually is developed at the closing date. So, but that is the model where it's based on. About, let's say, 45 million is cash, the balance will be issued in shares at the 970 mark to him. Now, we estimate that will more or less be anywhere between a 10 to a 20 cent dilution in the NAV per share at absolute rand value of 12.20 at that time and point. But that is before we do any of our asset management values, as we always do, and we enhance the property's value in the future. Then, in terms of the second question, I'll answer this as well. You plan to spend 4.7 million on the Bergrivier property. Kindly provide insight on how this amount will be utilized and give us a sense of your expected yield on the property post the capex spend. So the 4.7 million was actually included in our 9.35% yield that we disclosed. That is the actual yield that we anticipate at conclusion of our full spend on the property. 182 plus the 4.7 million capex. Now the capex will be spent in regularizing the mechanical and fire equipment to SPEAR standards. We have a set standard in our portfolio, how we like to operate our portfolios, to have a risk and insurance, and that's what we want to spend the money on to ensure it's the same standard so it can slot in perfectly with our insured portfolio. Two questions. You can take one, I'll take one.
Thank you.
So either of us can answer this, but let's split it equally. From Selma Jackson, what were the core operational and strategic drivers behind a 25.5% increase in distribution and pool, as well as the rise in the 3.0 DIPS year on year? Are these growth rates sustainable in the FY26 given the current economic headwinds?
For me, yeah. No, I think they are sustainable. I think that if you have a look at, we've got 19% of our portfolio coming up for renewal and relet, which means that the bulk of the income is on a 33-month weighted average lease expiry. So we are able to very conservatively forecast that growth will be consistent and sustainable. Hence the fact that we have forecasted growth of between 4 and 6% of the distributable income per share. Furthermore, as we also utilize some of that 74 million rands worth of free cash flow to further asset manage through PV solar, water augmentation opportunities and other non-GLA revenue like third-party signage and cell towers, that'll be basically just additional profit drivers to push up revenue and profit growth.
I'll do the next one. With a reduction in loan to value to 27.09% and a fixed debt ratio of 77.53%, what strategies are in place to manage interest rate risk and reduce the weighted average cost of debt in the fluctuating rate environment? So as we mentioned, we do have a strategy to have fixed debt between 65 and 75%. We do not mind tolerating slightly above and below this band as we operate in the portfolio, but we continuously speak to our bankers. Myself and Quintin, I think they are quite irritated by us. At the moment, some swap rates are announced. We are on the phone and say, please can we blend and extend, please. So we actively manage it on a daily basis. It's part of what we do every morning by 10 o'clock. They would have heard by us. If they haven't, then the rates are not good enough. So we work on it on a daily basis. And yes, we are always looking to lower margins. And I think our latest debt we did for the Emira transaction, as well as the refinance we're doing on the portfolio, we're getting 3-year JIBAR 3 plus 1.5 to 1.55, which I think is some of the best rates in the market, which is not actually through a bond market for actual normal standardized loans from the property. So we're very proud of that liquidity rating we do have from the banks and to continuously drive that margins down. Capano from Marzi. It's a twofold question. Where do acquisitions, developments, disposals and share buybacks rank in your capital allocation priorities?
Yeah, so I think, when we're trading, as I mentioned, when we're trading at a deep discount to our net asset value, strategically, we look at repurchasing of our shares. When we have extremely high occupancy rates and rental growth is very strong, then we look at kind of redeploying capital into capex programs to enhance our assets. When we have land opportunities through a strategic acquisition, as we have in the Blackheath node, where we've acquired an existing income-producing industrial park that comes with a land opportunity at effectively a zero cost. We then start to work on a future plan as to how we can unlock that value. So that kind of is the mixture. I think in the from an accretion perspective, as cost of equity one day comes down and cost of debt kind of also hopefully comes down, we'll then look at how we allocate between possible settling of debt versus issuance of shares. So for us, it's very fluid. Trading at a deep discount, obviously repurchasing, trading at a premium, issuing shares. That's the kind of methodology typically. However, we only, from an issuance perspective, would typically issue what we can utilize. There's no reason for us to go and do a big placement in the market if we can't actually deploy that type of capital over a period of time. So we are quite meticulous as to, strategically where the capital allocation kind of goes within the business. And we think it's a key part of building a long-term and sustainable business is having a very clear and well thought out capital allocation strategy.
I'll take the next one, also from Capano. What funding mix would you look at going forward for future acquisitions? Again, that is very fluid. It depends on every transaction. Some transactions comes with embedded debt that we have to take over, refinance, reduce to below our LTV levels. But we start off every acquisition and the review of it at the 40 to 45% level and understanding what level of debt can fit into the actual portfolio. If we can place capital, we obviously do speak to our shareholders, and depending on the level we can place and how much they will support, it reduces the level of debt. If we do have cash availability, we'll use that. All of them comes with different elements of actual cost of capital. So there's no set stones transaction. Everyone comes on its own merits, and we review it as such. Alistair Anderson is saying a lot of questions. Okay. Alistair Anderson from Property Flash. Would you look at places like Knysna and George for investments? And do you foresee Spear trying hospitality assets again?
So the first one's easy. We're already developing in George. We do see the whole of the Western Cape as an investment opportunity for Spear. So that is a straight answer. Secondly, we do not, for us, it's commercial, industrial, retail, mixed use. and and data center opportunities is certainly something that we are looking to pursue within the Western Cape region, but certainly not hospitality.
Another one from Alistair, it's quite an easy one. Are you seeing portfolios to buy in Cape Town?
Look, I think there are portfolios to buy, but it all depends on the price. And I think that's something that I've consistently kind of reinforced, that we are value investors. We're not just going to grow for the sake of growing. Portfolio opportunities do come up, but also we then have a look at how they're composed. What do they ultimately look like, and how much will it actually cost us to run these portfolios over a period of time? But by and large, it's more the kind of piecemeal, kind of single asset opportunities that are more prevalent in the market at the moment.
Then I think it's the final question online is from David Pfaff from Four Seasons Investments Management. Quintin, around the residential opportunity of 30,000 square meters, what do you feel is the selling price per square meter? Will there be units at this? Is it safe to work of the development cost of approximately 15 to 20,000 rand per square meter for residential? Where do you see the most demand for residential property? 1, 2 or 3 bed apartment, and what do you think is the mix might be after development?
That's a long question. Yeah. Okay, I'm going to try and remember. So I think from a saleable per square meter basis, we're pretty confident that from a Pod and Island perspective, we can probably achieve between 58 and 64,000 rand a square meter. The mix, what we've seen is studios, 1-bedders and 2-bedders. We haven't seen kind of convincing kind of evidence for kind of 3-bedroom type of accommodation. But we do see one thing that is for sure is that Cape Town is running out of quality residential opportunities. It could be a driver because of short-term letting, or it could be a driver because of land costs or affordability. But we do see Pod and Island, we see our Sable Square opportunity, that's around 200 units also, but that'll be more of a rental stock because we want to control the entire precinct, which is a 30,000 square meter retail asset. And then naturally the Atlantic Seaboard, but that's a far higher kind of end market, ranging from between about 70,000 square meters to 120,000 rand a square meter, which is not the market we operate in. So we're not standalone residential developers. We will kind of take on a residential component to a development as part of a greater development scheme, because we also we have a leniency towards kind of precinct style investment. Hence we own high quality assets in Century City as an example. Hence we wanted to do at scale development in Pod and Island, and obviously convert Sable Square from a pure resi commercial type of node to a full mixed use node, just given its proximity to Century City, but also proximity to public transport infrastructure. What was the other part of David's question? It was a long one.
I think you answered most of it.
Okay.
Yeah. But let's say you did.
Okay, we'll take it as answered. Yeah, that's all. Great, thank you everyone. Please join us for some snacks and drinks afterwards. But again, thank you for your support. We assure you that we know that we have an important job to do, and we consider it a privilege. Thank you very much.